Hello and welcome to the Finance Quarter. I'm Andrew Robertson. The devastation in Japan has played havoc with world financial markets as big investors try and work out what the long-term implications will be. Stock markets have been hit hard, and the question for you and me as small investors is, what will the impact be on our share portfolios? Well, a man who's been looking at this issue and will hopefully provide us with some answers is the Intelligent Investors Investment Director, Greg Hoffman. Greg, we've seen the stock market have a really rough ride since the Japanese earthquake and tsunami. What's your outlook for the market now?
Well, I think everybody's on edge now in the weeks following, obviously, as developments are unfolding in Japan. And that is from both the perspective, a company-specific perspective, what are the impacts of those events on companies, and also the fact that Japan is an important financial centre in the world. And they're an important investment hub, so a lot of Japanese investors and what they're doing with their money will push markets around on a day-to-day basis as well.
The market always seems to overreact, both down and up. Is it overreacting now?
Well, it's certainly been a big reaction in the Australian stock market, given that there's very few companies that are directly impacted in Australia by these events in Japan. So whether it's been an overreaction or not, time will tell, but it looks like a severe reaction just in a pure vacuum, I guess. But the Australian market's got its own peculiar issues other than the Japanese earthquake as well.
And I guess there are a number of sectors which come to mind that would be instantly affected by the earthquake and tsunami, such as insurers, uranium companies, property companies who might have dealings in Japan. How do you see it?
Most Australian investors, the first stock on their mind was probably QBE Insurance, a big $18 billion company that's exposed to these kinds of events and risks around the world. On the Monday after the quake, they were very fast in updating the market before it opened about their net exposure, which is estimated to be $125 million, and that's well within their catastrophe limit for the year still. So there's really nothing there for QBE shareholders to be unduly concerned about. The second major industry that people's attention has been focused on in the wake of the disasters is the uranium sector in Australia. And we're talking here of stocks like ERA, Paladin Resources and Extract Resources. They're the larger players in this industry, and they've all been hit very, very hard in the aftermath as people are reassessing the future for nuclear power around the world, and we've already seen some hawkish comments from various governments around the world on the industry. So investors are quite nervous about that. And then thirdly, we've got a couple of small property stocks that have direct investments in Japan. These are Astro Japan Property Trust, which was formerly a Babcock & Brown vehicle, and another one called Galileo Japan Trust, and both of those have been hit quite hard as well. Actually, on the Friday that the quake struck, Astro had just locked away a capital raising from investors, so they happened to time that very, very well. They made themselves a little bit more financially stable just before this terrible disaster struck.
You mentioned Japan in one of your earlier answers as a major global financial hub. It's also a major export of manufactured goods such as electronics and cars and so on. So what other sectors and what other companies do you see possibly being hit by this earthquake?
Well, this is a very interesting question for investors to grapple with. Once you get past the immediate impacts, what are going to be the effects, the flow-on effects over the next 6 or 12 months or so? And I think that's a difficult one to foresee. So there'll be some industries that will be thrown into chaos when we take this Japanese capacity offline. There'll be other industries that will benefit from the rebuilding, and we've seen some positive impacts on the Australian steel stocks. For instance, people anticipating that they'll benefit from the reconstruction effort. So it's always difficult to predict because these economies are so interrelated and they're so complex nowadays. It's very hard to predict with any certainty what the impacts will be, what other nations may be able to pick up the short-term slack of any capacity that's been taken out of the system. So it's just something I guess we all have to keep an eye on and keep abreast of as it unfolds.
Well, for those of us who do invest in the stock market directly, should our strategy change as a result of these events in Japan?
I think it depends what kind of investor you are. So if you're a short-term event-driven investor, then this is a huge short-term event that's having reverberations around the world. So that would have a big impact on your decisions. If you're more conservative, long-term investor, which is the kind of stocks or the kind of approach we have, there's probably not a lot to change around these events. You're always just looking to the longer term about what is the brand value, what is the management of the business like, what is the market position, what's the financial position, and there aren't that many stocks in Australia that are going to be significantly altered by this event.
So what I hear you saying is that even though the market as a whole has reacted strongly to the events in Japan, it's important that individual investors don't overreact.
That's right. Individual investors should simply consider their portfolios on a stock-by-stock basis, and there may even be some positives to come out of this in the medium term. So LNG is one industry that may well benefit from this. If there's a shift away from nuclear power towards LNG, Australia will be very, very well placed. Stocks like Woodside Petroleum and Santos and Oil Search that have big LNG projects coming on stream over the next few years, they would be obvious potential beneficiaries from an increase in demand for LNG.
Well, Greg Hoffman, some great advice there for our viewers. Thank you very much for your time. Already we're seeing the first signs of Australian companies being damaged by events in Japan, with surfing goods maker Billabong issuing a profit warning. Only time will tell if retailers, car companies and others who rely on imports from Japan will also be affected. But one man who remains confident is Wesfarmers boss Richard Goyder. He says it's important to remain focused on the long term.
So I would separate the short-term market gyrations, which are more around fear, I think, to hopefully as things unfold, confidence will rebuild, Japanese government will get on top of things, and you'll actually get a really significant rebuilding program, and that'll be good for infrastructure providers, steelmakers, a whole bunch of things.
Well, Wesfarmers is one company that could benefit from the Japanese earthquake because it owns a coal mine, and coal will be in big demand for both steel making and for power. Now, with the stock market on the nose, the Japanese crisis has once again called into question just how good an investment shares really are. The market grabs most of the headlines, but over the last 20 years or so, residential property returns have more than kept pace with those from shares. So where should we put our money? Shane Oliver is the chief economist at AMP Capital Investors. Shane, your research has shown that over the last 20 years or so, the stock market and the residential housing market have had similar returns. Does that surprise you?
It did surprise me when I first came up with the numbers, but it certainly is the case. If you go back over long periods of time, and I don't mean the last few years, you've really got to go back over long periods of time. In fact, if you go back to the 1920s, you basically find that shares and housing have similar returns, both in the order of around 11.5% per annum. And of course, there's times when shares do better, for example, through the 80s and 90s and coming into the last decade. Then, of course, there's times where housing does a lot better. And you could argue over the last few years, housing has done better than shares. But I think at the end of the day, they're both connected to the economy. The share market takes its lead from company profits, which depends on how the economy goes. The housing market takes its lead from population growth and income growth, of course, which are also related to how the economy goes. So, in a longer-term sense, it certainly makes sense that the two should have similar returns.
Well, speaking of gyrations, we're seeing the share market hit pretty hard at the moment because of what's happened in Japan. Is that likely to tilt the balance of returns between the stock market and residential property?
I don't think the situation in Japan will dramatically alter the relativities between housing and shares. Yes, it has a short-term impact because the share market takes the brunt of changes in investor sentiment. Whereas people won't be rushing out and selling houses on the back of the events in Japan. But my feeling is that the Japanese uncertainty and the tragedy which is unfolding there will have a slight negative impact on the Australian economy, but it won't derail growth in Australia, and nor will it derail global growth. So consequently, I think that we'll see the share market rebound. Now, if alternatively there is something that derails global growth, suppose the Japanese situation turns into a nuclear nightmare or China collapses, then it's debatable which one is most vulnerable, i.e. shares or housing. Initially you could say the share market will come down, but you could argue housing is also vulnerable because Australian house prices have had 15 years of fantastic gains, above average returns, And on all the reckoning that I do, all the analysis I do suggests that housing in Australia is very overvalued.
But notwithstanding that, you believe that Australians are much more active in the housing market than they are in the share market. Why do you think that?
Australians are active in the housing market in the sense that they tend to be more exposed to it, lesser exposure to shares. And I think Australians are more comfortable with housing because it's bricks and mortar. They can actually touch it and feel it, and that gives a degree of comfort. Whereas when it comes to the share market, it's a bit more removed, if you like. And so as a result, I think Australians have this comfort with investing in shares, and they're also given a bit of an inducement there because negative gearing exists. Of course, you can also negative gear